Hey Bowtie Nation, Joseph Hogue here, and you ever feel like the stock market is one big inside joke and you're the punchline? You're buying stocks, maybe reading some stock research or watching some guy in a bow tie talk about valuations, and yet somehow your portfolio performs like a three-legged donkey in the Kentucky Derby. Well, you're not alone. According to researcher Dalbar, who's been studying investor behavior longer than most of us have been alive, the average investor missed the market return by 3% a year over the last 30, which might not seem like much, but consider the difference would cost you almost $1.3 million over that period. And that's when the market is being nice, when stocks are rising. If you're like most investors this year, you've been beaten and battered with that market chaos and are losing a hell of a lot more than that 2.9% return on the S&P 500. Well, I'm going to tell you, it's not just bad luck, and it's not Wall Street rigging the game, though they're not doing that too. No, the real reason you're losing money hits a little closer to home. In fact, it might be you. That's why I'm breaking down the 7 biggest mistakes investors make, why your brain is hardwired to make them, and how to stop. We're talking about holding garbage stocks like they're your favorite child, selling your winners faster than a sushi salesman in the Phoenix Sun, and thinking a 10% dividend means you're about to retire. These right here are the biggest traps that cost real investors real money, and if you're brave enough to stick with me, I'm going to show you not only each, I'll show you how to stop making them. But let's be honest here, folks. Most investors aren't going to watch this video. It's not a list of hot stocks to buy, and nobody wants to be told that they're investing like a firefighter that shows up with a flamethrower. But you're here, and that means you might actually be ready to stop bleeding money and start investing like someone who deserves to win. Let's get started with our first mistake, costing you money, following the crowd instead of doing your own research. Now, folks, I'm not kidding when I say most investors spend more time choosing their burrito toppings than they do picking a stock. New research found that the average investor spends just 6 minutes before deciding to buy a stock, and worse still, 73% of that time, more than 4 seconds, was spent just looking at the price chart. That leaves less than 2 seconds on average spent looking at earnings or other fundamentals. Now hey, part of this is just good old-fashioned laziness, but more than that, investors give into that herd mentality that dooms your money. They assume that YouTuber that just a few years ago was doing videos about dating knows how to pick stocks. They see a chart of a stock price, get dollar signs in their eyes, and that fear of missing out before they go all in with their money. And I know, it's easy and it feels like research watching a video, but it misses those red flags that you only see by actually digging into a stock. And fortunately, this one is easy to fix. Create a simple research checklist you go through before buying any stock. In fact, I'll link to a video in the description that's going to give you that checklist you can do in just 5 minutes. It's not the weeks-long process I spent analyzing new investments as a venture capital analyst, but it's where you want to start, and it's going to put you ahead of 90% of the investors out there. We're just getting started, but even knowing these 7 investor mistakes is going to be pointless if you don't start with an investing plan right for you. It's why I created this quick 3-step guide to making your investing plan. Within 5 minutes, you'll be able to create an investing plan that makes your goals the motivation to keep investing, and that is customized to your needs. I'll leave the link below in the description. It's totally free, just something I wanted to put together for all you out there in the community. So click through and get your step-by-step guide. Folks, I've seen too many investors miss out on the opportunity to make their money work for them, and it's because they didn't have a plan that fit their needs. So look for that link and get your free customized plan. Back to our list, and even when those quick stock picks work out, investors too often sell their winners too fast, missing out on more upside, and hold on to their losers too long. This is a painful one, and every investor has a story to go along with it. One stock you bought jumps 15%, so you rush to lock in those profits, feeling like a genius, right before it doubles over the next 6 months. Meanwhile, your other stock here is down 30%, so naturally you hold on because it can't go lower, right? And this one is deep in our evolutionary brain, the fear of loss that kept those first humans alive after coming down from the trees. Our emotional wiring makes us crave that satisfaction of the win, even a small one, while we avoid the pain of a loss at all costs. And the result? You end up flipping out of those solid performers for pocket change and then clinging onto the garbage stocks like they owe you an apology. And in fact, you should be doing just the opposite here. One analysis by Vanguard of 100,000 investors showed the ones that held on to their winners, even buying more, while they cut their losers early, earned at higher risk-adjusted returns over time. Now, fixing this problem means setting sell targets before you buy a stock, so knowing where you're going to sell it on the high and low side. Also, review your portfolio every 3 to 6 months. Ask yourself for each stock, would you buy it today? And this next mistake, investors say they're long-term holding a stock, but then act like day traders. Nation, take a look at the average holding period for a stock here. This is from the New York Stock Exchange data, and around the 60s, investors would be holding onto a stock for 8 years after buying it. Now fast forward to the new millennium and investors are holding their stocks for less than 5 months. Investors are acting like a crow in a jewelry store, distracted by anything shiny. No idea what it's worth, but absolutely sure they need it. And on this one, it's hard not to blame the social network revolution here. Click over to YouTube and you're going to see 20 stock picks in less than 5 minutes, all of which are going to make you millions of dollars. Combine this with that dopamine rush that comes from clicking buy on a stock, that instant gratification, and it's easy to see why so many investors are trading in and out of their stocks. Now fixing this, avoiding falling for that short-term noise and getting the upside returns that only come with that long-term investing means setting clear goals, having long-term objectives for your portfolio and the money, plus following some of those selling rules from our previous mistake. And here's a mistake that's going to be especially painful for some, chasing high-yield dividend stocks only to see the price plunge. And I get it, there's nothing like seeing that cash flow hit your account, and the only thing better than a dividend is a super high dividend, rates of 10 or 12 or even 15% yield on your money. The problem is, chasing those highest yielding stocks can be one of the fastest ways to turn your portfolio into a ticking time bomb. We can use the Global X Super Dividend ETF, the SDIV, as an example here. And the price doesn't seem to go anywhere, but who the hell cares when you're getting an 11% return on your money and that sweet, sweet dividends every month? Now the problem is, when you zoom out, you see the stock has lost 72% of its value since inception, a loss of more than 9% a year. In fact, analysis by the Wall Street Journal found that not only had investors lost money over the 13 years, but they were out on the 175% return on investment in just a straight index fund would have provided. And I know dividend stocks feel safe, and that double-digit yield is tempting. You might tell yourself it doesn't matter if the price is falling if you never plan on selling, but it's like buying a house built on a swamp. Eventually you're fighting off gators and forced to move. Now folks, there are some great dividend stocks out there, and I'm going to link to a video on some safe high-yield stocks in the description below, but instead of chasing that yield, focus on total return, the price and the dividend return combined. Also, before jumping into that dividend stock, look for some of the metrics we talk about here on the channel, like payout ratio and cash flow, to analyze that stock. And before those next 3 mistakes, 3 of the worst that are going to destroy your portfolio, I want to give you a dead simple process for breaking any bad investing habit because, let's face it, most of us invest like we're playing poker with our cards facing out. And step 1, be honest about your returns, not those fantasy numbers in your head, your actual returns. Most investors think they're killing it, but if they looked at their portfolio growth after subtracting their deposits, they'd realize that they're just slowly turning their retirement into a very expensive hobby. This means tracking your results with a spreadsheet or a notebook, hell, a cocktail napkin. Just write down the stocks you've sold and whether you've made or lost money on each. That's your truth serum. Step number 2, admit you're making mistakes. Yeah, I know nobody wants to be told they invest like they get their stock tips from a fortune cookie, but like they say, the first step to recovery is admitting your portfolio is a train wreck. And finally, step number 3, just create a process that stops you from making that same mistake over and over again. It can be a checklist, portfolio rules, hell, your post-it notes on your monitor that says, don't be stupid today. And nation, most investors won't even have made it this far in the video, so I'm glad you're still here, and I appreciate your time. I want to get back to our list. But even more, I want you to make money investing. I want you to reach your financial goals. I know this is hard work, making plans and following those investing rules rather than just getting another list of stocks to buy. But this right here, this is going to make you a better investor. Mistake number 5 is like evil Santa, coming once a year to take your money, ignoring taxes in your investments. And this is one that most investors never see coming and can come from any number of choices. The worst is the massive tax bite you pay if you don't hold your stocks for more than a year. Profits on stocks you hold longer than that are taxed at capital gains rates, which for most investors are just 15%. You don't pay them until you sell a stock. Trade in and out of your stocks though, holding them for less than a year, any profit is added to your income and taxed at those much higher rates. And I know what you're thinking. Yeah, but what if I can get a higher return trading stocks? What if I can beat the market? Well, Uncle Sam wants you to try. Here's 2 investors, each starting with a $10,000 portfolio. The buy and hold investor earns the market return, just 10.2%, buys his stocks and holds them for 30 years. After paying that 15% cap gains tax, he's got a portfolio over $158,000, almost 1,500% return. Our stock trader, though, even one as savvy as Warren Buffett, who was able to earn 11.9% annually over the last 30 years, beating the market, even on that higher return, and assuming you're in the 32% income tax bracket, after those 3 decades, you're up just $103,000. The better investor here is out 55,000, and it's all because of taxes. And that pain doesn't stop with short-term traders. Even long-term dividend investors can feel it. You pay taxes on your dividends received every year, whether you reinvest or spend that money. Taxed at the 15% dividend rate, an investor in Coca-Cola is out more than $48,000 over 26 years. Taxes you pay every year and money that isn't working for you. 3 steps you can take here that is going to save you hundreds of thousands of dollars. First is hold any dividend-paying stocks in a tax-deferred retirement accounts. You won't pay taxes each year on these, keeping those dividend cash and making it continue to work for you. In your taxable accounts, hold those stocks for at least a year to pay those lower capital gains tax. But the longer you hold them, the longer those profits are going to keep compounding. And third here, use that tax loss harvesting towards the end of the year, selling some of your losers to offset the profits in other stocks and lower your net taxable gains. Here's one that ties in with a lot of the others on the list, trying to time the market. Every investor has that moment. You look at the news, you feel a little nervous and think, if I sell now, I can buy back in later when it's safer and avoid the crash. Congratulations, you just tried to time the market, and statistically, you probably just torched your returns. And I know market timing feels smart. It gives you that feeling of control, but even the pros rarely get it right, jumping in and out of the market. The problem is missing out on just a few days can kill your portfolio. A $10,000 portfolio invested in 2003 would have grown to almost $65,000 over the next 20 years. Try timing the market though and miss on just 10 of the best days over that period, you'd be out more than half the amount. And that's just 10 days missed. Now, those of you out there in the nation know I don't just buy and hold my stocks no matter what. There are strategies you can use though to lower your risk when the market looks ready for a crash. Now, I've used one option strategy on my shares of SMCI to make over $61,000, even as the stock fell lower from the February high. I also used a put option spread on the S&P 500 fund recently to earn a profit of over $21,000 when the market fell in April, cushioning the fall in my other stocks. Now, a lot of that risk reduction in the income strategies means using options, so I'm going to link to a special coupon code to our Ultimate Options course in the description. Use it and get $150 off, along with a 14-day money-back guarantee. Without those option strategies, accept those market ups and downs as just a part of investing. Stock prices will rise over the long term, and you don't need to do anything but buy and hold if you don't want to. Stick to that long-term strategy and hold some cash back to buy in when the market does fall. Now, this next mistake is one that's going to put your portfolio to sleep for years, killing any chance of return. But even better than not losing money on your stocks is actually making money. Make sure you watch the video here in the corner next, and I'll show you how just $1,000 in 5 stocks is going to replace your job. Our 7th investor mistake is one you won't hear as often, but is going to lose you just as much money, getting emotionally invested in a stock. Now, folks, there is nothing wrong with liking a great product and even a fan of a great company, but some investors, they don't love a stock. They imprint on it like a baby duck. And I get it. When a stock makes you as much money as, say, Tesla, rising 4,600% in 2 years, you want to name your firstborn Elon. But when that past blinds you to weakening fundamentals, to a legitimate bear case for the stock, that's when the problem starts. You defend it on Reddit, you troll anyone that says anything on YouTube, and just generally avoid looking honestly at that stock. And nation, that is how a portfolio dies. Not with a crash, but with a slow, stubborn refusal to let go of a loser because of what it's done in the past. Love your friends and family, but stay unemotional about your stocks. When you review your portfolio, ask yourself, if I didn't own this stock, would I buy it today? And do all the same research that you would on a new stock. Track that stock's performance in cold, hard numbers. No feelings or nostalgia, and always look for both the bull and bear case arguments when you're analyzing that stock. Look for the link in the description below for your personalized investing plan. 5 simple steps to create a plan that fits your goals and your needs, or click on the video to the right for those 5 stocks that'll replace your job. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.